Will the Toronto real estate market ever crash? Yes, is the short answer. But the truth is, that doesn't really help you. What you really need to know is how you should think about risk. Hey friends, I'm Paul Haley, Toronto realtor, investor, educator, and speaker, and I want to help you think about investing and risk. I got this comment on my recent market update, and it said, I'm thinking of investing in real estate. Will the market ever correct? And of course, I just kind of answered it like, blah, 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 short term, long term, here's what's going to happen, supply issues, inflation, all that kind of stuff. If you want to know more about that, check out this video. But then I was thinking, that's actually not really helping that much. The real question they're asking, the underlying question we need to answer is, as a real estate investor, how should you think about risk? Now that is a great question. And if we don't address this question, you're really going to get stuck in analysis paralysis and trying to figure out what markets are going to do and all that kind of stuff. It doesn't really help you. It's just going to keep you from getting into the market. So what is risk? So sophisticated investors realize that every investment has risk, right? And risk really means it's not going to appreciate, it's not going to go up the way you thought it was going to go up, or something's going to happen to your investment that was unanticipated. And really there's market risk, so the whole real estate market as a whole, or the whole stock market as a whole is going to crash. And there's individual investment risk, right? So how is that investment going to do compared to all the other ones? And typically, what investors do is they diversify to reduce risk. So they'll buy gold, stocks, Bitcoin, real estate. They'll diversify markets to diversify risk, and they'll diversify investments. So they'll buy lots of different stocks or lots of different types of e-coin or different properties, right, in different geographies. That's how they reduce their overall risk. Now, if you're gonna diversify across geographies, there are a few things you need to think about. And so what you want to do is you want to buy in cities that are growing population-wise, that are creating jobs, and they're creating high-paying jobs where housing isn't keeping up with those things. A city like Toronto, where we're doing all those things, lots of people are moving here, we're creating high-paying jobs, and we just can't build housing fast enough. So how do you evaluate risk for a real estate investment? Okay, so remember, when we're talking about buy and hold strategies, there are 4 ways that you make money, right? So there's the cash flow, there's the mortgage pay down, there's forced appreciation through development, and there's market appreciation. Now the first 3 are pretty much a lock, right? I can tell you, what your cash flows are going to be. I can tell you what your mortgage pay down is going to be based on all your inputs. I can tell you, if you do some renos and improve the property, I can tell you, at a minimum how much that's going to improve the value of your property. The real unknown here is market appreciation, right? And truthfully, for most buy and hold investors, market appreciation is really a bonus, and the market could turn temporarily, but if you're buying in the right place, if you're buying in a city like Toronto, then long-term buy and hold, you will get market appreciation. Here we've had crazy market appreciation, to put it lightly. And for a fix and flip, the risks are different. The risks are really, what is your plan? How long is it going to take you to execute that plan? What are your costs? And what's your ARV, or after rental value? And in that situation, the first 2 are within your control, right? And really, you have to ask these questions. Are you doing the right flip for the market and the area you're in? Is the plan right? Have you done the right timelines? Have you estimated the cost properly? Have you really thoroughly thought about the after rental value, the ARV, and what's that going to be? So there's lots of ways to mitigate this risk. So like a buy and hold, even with a fix and flip, there is risk mitigation in that you can just rent the property out, right? You don't have to sell it. So, part of it is making sure you're buying in neighborhoods that have a high ARV ceiling, right? So, if you're buying in a neighborhood where the most property sold for is like 1.8 million, honestly, it's going to be tough, really to make money. But if you're buying in, a neighborhood where properties have sold for 3 million plus, then you're good. It's going to be hard to really over renovate those type of properties. I've still seen people do it wrong, so you got to be careful. But, it is a bit harder, and hopefully with the right guidance, you can get there. But the risk mitigation is really like, listen, if the market turns against you for a short period of time, which in a city like Toronto, any market correction will be short-lived because, like I said, structurally, we are going to be way undersupplied. And really, in that case, you just rent it out, right? So you refinance, you hopefully get most of your money back, and then you rent it out and you cash flow a couple grand a year for a few years and then sell it and then you're good, right? It's just, whether your financing allows that. I guess the other risk mitigation in a flip is really the plan, and it's making sure you do it quickly, right? So, I see a lot of flippers that get into trouble because it takes them 2 years to flip a property, right? You should be able to, your plan should be, we're going to do it quick so we can turn it over. There's less market risk that way. And actually your ROI goes up, right? Because you're investing for a shorter period of time. So that's all good, Paul Haley. But should I invest now? What's going to happen now? Is the market going to crash? If you want more info about the market, check out this video. But, the question you're really asking is, can I time the market? Should I time the market? Should I wait until the market corrects and then buy, right? There are 3 problems with this. The first is the market may not correct, right? You may be sitting on the sidelines for a very long time and it may actually double before it corrects and you would have missed out. The second thing is timing any market takes a lot of discipline and experience, and it's very, very difficult. And the third problem is the cycle of fear and greed, right? So if you're going to time a market, you're going to buy when everyone else is selling and all the headlines are saying, the sky is falling. That's very difficult to buy in that environment. It also means you're going to sell when everyone's talking about how much money they're making in real estate, all that kind of stuff. That is also very difficult. And in my experience, it really happens the other way. People think they're going to time a market, but they do it wrong. They do it the exact opposite. And listen, the truth is, I talk to a lot of investors. I have investors as clients and friends, and, I'm in some investors groups. And suffice it to say, I talk to a lot of investors. And investors don't really talk about a market crash. They're not like, oh my gosh, the sky's falling. Oh, should I wait? It's not really their how they think, right? True investors, sophisticated investors, they're always looking for opportunities. Right now, they will say it's taking a bit more time to find opportunities. It's a bit harder to find opportunities, but they are still looking for opportunities, right? And when we do find an opportunity, they're very excited about it. They're excited about, the low interest rates because it makes a lot more things possible. And they're excited about freeing up capital to do more and more investing projects. They're not thinking about timing the market. They know if there is a short-term correction, if they've done things right, if they've bought in the right markets, then it'll be short-term. It'll be short-lived, and they can wait it out. And, long run, the strategy is still a great way to create wealth. So I hope you found that hugely helpful. If you have any questions about investing, about risk, how to think about risk, please shoot us an email, info@thinkto.ca. Please leave a comment below, and please like this video so I'll know to make more of this type of content. And please smash that subscribe button so you get updated each and every week when we post new videos. Talk soon.